Great. So, welcome to another episode of my podcast, Investing in the USA. And today we have a great guest, a new friend of mine, Ahmet Kalkan from Kalkan Capital. He and his family actually have been investing in the Houston area for 30 years, right?
Yeah, just about 30 years.
Great, great. So we're excited to hear how that came to happen, and let's get right in. So tell us a little bit more about your story. Like, how do you start? Was it you alone? I know it came from your dad, but like, tell me more.
Yeah, of course. First of all, thank you for having me, Luis. It's a pleasure to get to talk to you
Yeah.
and be a part of your podcast. My name's Ahmet Kalkan. I'm the second generation of Kalkan Capital. The first generation, Dr. Kalkan, he started the company in the early 90s, late 80s. His story is interesting because he's actually coming from an educational background. Every year, the Turkish government, which is our ethnicity, gives a nationwide exam to students. And, the top 250, top 300 students in the nation get full ride scholarships overseas. And Dr. Kalkan was one of those blessed students to get the scholarship, and his field was geophysics. And in the field of geophysics, Texas A&M is world renowned to be one of the leading universities. So he got a scholarship to Texas A&M University, and he did his master's and PhD at Texas A&M University. He gave lectures at Texas A&M University, and during his stay in College Station, which is the city where Texas A&M is located, there was an oil and gas crisis in the late 80s. And practically every local bank bankrupted, many of the landlords bankrupted, and the duplex that Dr. Kalkan was living in also bankrupted. And at the time, the RTC was formed, and they contacted Dr. Kalkan and they said that, hey, if you'd like to own the duplex that you're renting out, that you're a tenant of, the government will guarantee your loan and you can be a homeowner. So he said, yeah, sure, no problem. I'd love to try that. And they said, okay, you're going to have to go to an auction. And if you win the auction, the property is yours. So, okay, so he went to auction. And he's quite an introverted character. So it was his first experience in such a setting. And long story short, he won. And when he got in line to, fill out the paperwork, they asked him, have you arranged your mortgage to acquire the property? And he's not from real estate. So he's like, what's a mortgage? So they're like, okay, have you arranged your earnest money? He's like, well, what's an earnest money? So like, okay, Dr. Kalkan, just go to the back of the line. Let's get everyone taken care of, and at the end we'll take care of you. So he went to the back of the line. He waited his turn. At the end of the day, they awarded him the property. In fact, he didn't know that he was bidding on two duplexes. He thought he was bidding on one. And again, you're getting these properties pennies on the dollar because there's a big oil crisis in especially in the southern states where oil is predominantly a strong industry. So he ends up with two duplexes. He's living in one, and he's renting out the other three. And at the time, his university scholarship was $570. And all of a sudden, he's making more than that in real estate. And he thinks to himself, well, I have to do all this research. I have to give classes. I'm working, 16, 17, 18-hour days at the university. And my three tenants who I never hear, never talk to, gives me the same amount of money. I like this real estate industry. And he says, let me continue. And at the end of his first year in real estate, he ends up acquiring, I believe, 19 to 20 units. They're small houses, duplexes here and there, all assumable loans. He assumed all the loans, zero equity. So at the end of his first year, he acquired about 20 properties, and he quit his job at the university and became a full-time real estate investor. And that's how our story began. Now, our business strategy evolved because of these circumstances. Since he's a student, well, not a student, once he's a professor He didn't have saved equity. He didn't have raised capital at the time, and there wasn't syndicators or things like that back in the late 80s, early 90s. So the only way he can acquire a property was by assuming the loan. Well, typically when you're assuming a loan, it's going to be a distressed property where you don't have to put any equity down. So all of a sudden he has these 20 properties. They're all in awkward locations. They all have one challenge or another. And he quickly realizes that the efficiency of running around to 20 different properties all over town isn't a great idea. So he says, okay, I'm going to sell these 20 houses, switch to fourplexes, switch to small apartments. And that's what he does. He liquidates everything. He ends up buying one small apartment complex for about 50 units. And now, all of his units are concentrated on one location. He's able to focus there full time and he grows. He stabilizes the property. He does a cash out refi. He goes off and buys the next one. He stabilizes that one. He does a cash out refi and he moves on to the next one.
But Ahmed, how did he do that? I mean, like, did he need any money to do that? I mean, I guess did he use the money that he acquired, like he got from selling those properties, those 19 properties or 20 properties that he had, or did he have any partners at the time, or like how did he do that? Or and also, when you said that he acquired a lot of these properties, his first properties, assuming the loan, can you tell us more about what that means? I mean, we just want people that don't know what you're talking about to understand a little bit more about that part too.
Absolutely, absolutely. So, on a typical purchase of an asset, let's say a house, the bank will put down a certain portion of the financing, and the purchaser will put down a certain percent. It's going to be around, 60, 70, 75% bank, 20, 25% the purchaser. The money that the purchaser puts down is called the equity. The money the bank puts down is called the loan. It's the debt. Now, in worst case scenarios where the purchaser is not able to operate the property, the bank may take over the property back because honestly, whose property is this? The bank's putting down 75%, you're putting down 25%.
Right.
So if the bank doesn't like how things are going, they have the right to take over the property. It's called a repossession.
Yep.
And when they do that, they wipe out your equity. The 25% that you put on the table, that gets erased. You lose your money. So all that's left is the 75% debt.
So yes. That means that he was actually acquiring the properties directly from the bank. There wasn't any middleman or anything like that.
He was acquiring it directly from the banks. Yes. Okay. So when you buy it directly from the bank, at least you're getting about a 25% discount because the previous owner's 25% equity got wiped out.
Sure.
So when you buy that as 25% discount and you stabilize it, now you have created that value back. You're able to operate it again. Now the value is back to its original 100%. And then you have two options. You can do a refinance, which basically goes to the bank and says, look, when we were purchasing this, we agreed 75%, 25%, but now the value increased. You need to protect your margin. Give me more cash because the value of the property has increased. Your 75% is no longer equating to 75% now.
Sure.
Or another option is to sell the property. Now, Dr. Kalkan sold these properties at the very beginning because one of the main ideas he has is that, okay, I need to concentrate my efforts in a certain region instead of running around. So selling made sense to him. So when he first sold those, that's when he acquired equity for the first time. Mm. With that equity, he went off and bought his new properties. Now those properties are stabilizing and their value is increasing. And then he does this again. He goes back to the bank and says, the value has increased. Protect your 75%. Give me a cash out refinance. So they refinance, they rearrange the loan structure. And Dr. Kalkan from that gets to pull his money out. And then he goes and does that again. He did not start this with any partners. He's the sole owner. And that's how he came to this day. Right now we have around 10,000 units. So he started from 2 duplexes, so 4 units total. In a span of about 30 years, now he's at 10,000 units. And this was the model. Buy, stabilize, refinance, move on to the next one, and just keep growing, keep growing.
And so it took pretty much 30 years from 4 units to more than 10,000 units, right?
Yes, exactly. That's
an amazing story.
Along the way, the business plan developed. It evolved on its own. For example, he started off by buying these repossessed properties or assuming these loans. So he was becoming specialized in taking care of distressed properties, because if you want the most affordable properties, it's going to come with some problem. It could be a tenant problem. Maybe the tenant's not paying rent. It could be a structural problem. It could be a problem with the loan, whatever. It comes with some problem. So without intending to, he became specialized in stabilizing value add properties. And he continued with that. When he grew into apartment complexes, he continued purchasing value add apartment complexes, meaning, there's value to be added to the property. If you buy it now, there is things that you can do to increase its value. For example, if you were to buy a brand new apartment complex, what can I do to that property to increase its value? There's really not much to do because it's already brand new. A brand new property is going to bring you strong cash flow, but it's not going to bring you value add unless you keep it for 10, 15, 20 years and the market appreciates and that way your asset appreciates passively. But if you purchase a property that requires stabilization to where you can add value, now you have two revenue streams. You have the value of the property appreciating and you have cash flow. And this is what Dr. Kalkan was targeting. He always targeted properties to where he will receive cash flow and the property's value will increase as he stabilizes it.
Let me ask you something about that, because I'm not gonna follow the pattern that I have here for questions, because you touched on a point that I was gonna touch later. But since you're talking about that, I want to ask you now. So what type of value add do you guys do? I'm in the real estate space as well. And usually when you talk about value add, a lot of people think that it's just, makeup or lipstick type of thing. Like, you paint here, you change the counters, and, and basically the value of the rent per apartment is going to go up $50, $75, maybe $100. So I know that's not the case in your case. So please tell us about what you guys did to value add in this program.
Yes. Absolutely. That's a great question, because that's the backbone of our entire business plan. First and foremost, we are not like the companies that buy a property, splash some paint, and flip it. That seems to be what you're referring to. Put some lipstick, put some makeup on it, jack up the rents $100 and then sell it. That's not really what we do. First of all, those such apartments, you are not going to get a deep discount. It might be a value add. Let's say we target a deep value add. I want a very significant value add, maybe doubling the value of the property. In scenarios that you have explained, the NOI might grow 10%, the value of the property might grow 10%, maybe 20%, and that's fine. That's one business model. The model that we are pursuing, I expect the property's value to at least double in the course of 1 or 2 years. So let's differentiate that by saying value add and deep value add. We like deep value add.
And how do you achieve that?
Yes, how do you achieve that? That's a very good question. You achieve that primarily from, well, first you need to understand how a property's value is determined. How do you know that this property's value has doubled? There are many metrics. You could look at nearby comps, whatnot, but the most important metric is your NOI. How much money is this property making? There's a direct correlation between the NOI and the property value. Of course, interest rates play a factor, cap rates play a factor, but long story short, it's NOI. So when we buy a property, let's say it's 50% vacant, or let's say it's 20% occupied, 80% vacancy. Now, just by increasing its occupancy up to 90%, 95%, 100%, I am tripling, quadrupling my rent income. And consequently, the value of the property is also skyrocketing. So it's not that I'm buying a property that is 100% occupied and I'm increasing the rent value $100. No, I'm buying properties that have occupancy issues, that is 50% vacant, to where if I fill it up from 50% to 100%, my NOI has doubled. The value of my property has doubled. And now you might ask, okay, why is the property 50% occupied? The most important factor, in my opinion, when it comes to real estate is, one, buying the right property. You make money when you purchase the right property, knowing what you're looking at, understanding the opportunity. And secondly, it's the operations. You know, most people, they treat real estate as a passive income. They treat it somewhat like the stock market, buy low, sell high. But they tend to ignore the most crucial factor, which is the human factor. There's a community, there's a human factor that you need to take into consideration. For example, my portfolio, if I have 10,000 units, let's say a mother, father, two children in every apartment, I have 40,000 people that is my responsibility to take care of. Now, if my only focus is buy low, sell high, treat it like passive income, and I ignore the needs of 40,000 people, how is that going to affect my business? So we completely do the opposite. We focus on the residents, we focus on the tenants, we focus on the community, and the money follows. We're not focused on the numbers, the money. No, we believe that success will bring the money. Let's focus on being successful. What is a successful project to us? A property that is clean, quiet, safe, and friendly. Now, clean, quiet, safe, and friendly. For me to achieve this, let's say I bought a distressed property. Let's say it has low occupancy, it has some crime issues, it has a bad management. Day one, when I first take over, the first thing we do is introduce ourselves to the community, because the community needs to understand that things are changing hand. We introduce ourselves door by door. We personally go and we introduce ourselves, and we say, you know, we're here to take care of you. You take care of us, you take care of the community, we will take care of your needs, and let's improve the community together. And that's very surprising to many of the tenants, because let's face it, when does a tenant actually meet the landlord? At least for apartment complexes, you know? Maybe
Almost
if you're
never.
renting a
Yeah,
house.
almost never. I mean, so you guys
Almost,
do that yourselves, like you and your dad,
yes.
you actually do that yourself in person.
Yes, we do that in person. I understand that that may sound very micromanagerial. There are certain things in real estate that you should micromanage. There are certain things that are not worth delegating. There is a difference between me sending my manager to every door and me going myself to every door and introducing myself not as the manager of this property, but the owner of this property. And that sets a new tone. Oh, wow, the landlord took time out of his day and showed enough care to come to my doorstep, knock on the door, and introduce himself. So that's the first thing we do, is introduce ourselves. And then we improve the property by installing lights, operating the gates, providing private security, and most importantly, bringing in our specialized management team. Because real estate has many avenues. You could do hotels, you could do commercial buildings, you could do office space, you could do warehouses. We are in multifamily apartment complexes. That is all we touch. And that's contrary to what the general knowledge of investing is, which is diversify. Everybody says diversify, don't put all your eggs in the same basket. This is the safest method of investment. We disagree. We believe that investing is a form of survival of the fittest. Whoever is most specialized, whoever is the most successful in that field will be the one to survive. If I have a couple apartment complexes, a couple warehouses, a couple hotels, whichever sector enters a crisis, how am I going to survive? In any of those sectors. If the warehouses take a hit, how am I going to survive? I'm not specialized in it. If hotels take a hit, how am I going to survive? But if all I focus on is multifamily, and if my entire goal is to do this better than anybody else, and then there's a downturn in the market, then who's going to survive? I'm going to be the one to survive. So we specialize in this. I hope I was able to answer your question, how we
Definitely,
create value.
definitely, for sure, for sure. And let me ask you something else. So, what were your biggest hurdles growing from, you know, a couple of hundred units to tens of thousands of units?
Yes. First and foremost, it's important to choose a good market. Okay. This opportunity exists in many places, but not in every place. For example, we started in the city of College Station. The city of College Station is a fraction of the city of Houston. So immediately you have a supply issue in the city of College Station. How many apartment complexes are there to purchase?
Yeah.
So there will be a waiting period for available properties to come online. So that's one thing, is locating a good market to invest in long term. We started in College Station and eventually we liquidated our assets and we moved to Houston because Houston is a much bigger market. And that's how we solved that problem. Now, any day of the week, you call me and you say, hey, I want to buy an apartment complex together with you. I have a stack of apartment complexes available in the market ready to be purchased. I have never had a difficulty locating a supply in Houston. So the market matters. That was one of the hurdles. The second hurdle is equity. Equity, remember, is the portion of the money that you put down in order to purchase a property. Now, since our traditional form of purchasing properties is cash out refinances, the only way I'm able to acquire equity is I need to buy that property. I need to stabilize that property. So that can take 2-3 years before I get a hold of my equity, before I create value to be able to buy the next property. So the name of the game was I can grow as fast as the equity that I have. Now, the way we mitigated that problem is by improving our efficiency, improving our management. What took us 3 years in early 2000s now takes us 1 year. You can give me any apartment complex, and I'm willing to bet that I can stabilize it and prepare it for a refinance or a sale at the end of 1 year. So maximum in 1 year, I should be able to do a cash out refinance and get some equity to buy the next one. Now, is 1 year good? Under normal circumstances, 1 year is great. You know, any apartment complex, stabilize it in 1 year. Typically, these take 3 years, 5 years, and what have you. So 1 year is great, but that still is a time frame that I have to wait on. I have to wait on 1 year. So now I'm trying to push that. I'm trying to push it to, can we do it in 9 months? Can we do it in 6 months? Or another option is, can we bring in partners? Can we fundraise? Can we bring in equity instead of solely relying on this stabilization and refinance platform that we built over the years? So those are the two major hurdles: picking a good market where supply is available to buy, and taking care of the equity portion of these purchases.
Perfect. Great. Let me ask you something else. So what strategies or philosophies does Kalkan Capital have that other people don't have, and what makes you different to those people then?
I'd say the biggest difference between us and most other real estate investment companies is that we are hands-on managers. We own and operate our own properties. Most other companies, they have a third-party management, a separate company that will come in and manage the assets. The investors will only focus on the purchase. They will buy it and then they will pass it on to a third party management, and that third party, that separate company will run the property. We don't do that. From beginning to end, we are present in every step of real estate, from purchasing to negotiations to leasing the property to preparing the apartments to renovating the apartments, to selling the property. A to Z, we're vertically integrated. Anything that you can have related to multifamily real estate is present in our company. This gives me two advantages. One, I'm faster than everybody else. Because if you're working for a third-party management, if you're working with contractor companies for every little thing, well, you're going to have to go at their speed. For example, you need a new carpet. You call the carpet company, I need a new carpet. The first thing they're going to do is schedule you. They're going to schedule you maybe 5 days later, maybe a week later, whatever. With us, we have carpet installers within the company. I hired them from carpet companies. We create the schedule depending on our priorities. We are not dependent on any external factors. The second advantage that we have is our cost base is more affordable than everybody else. Because if, for example, you have one apartment complex, Mr. Luis, and you gave it to a third-party management, and that third-party management is doing renovations. They call the supplier and they say, you know, I need one dishwasher, or I need 3 ceiling fans, or I need 4 faucets. Okay, I have 10,000 units. They are all using the same standardized parts. You go to any one of my apartment complexes, we use the same parts. This helps me with training. When I transfer a worker from one property to another, there's no need to go over training again. He knows how to use the same parts because they were used at his previous property. but also it helps me with purchasing power. When I call the supplier, I don't say, give me one dishwasher, give me two ceiling fans, give me four faucets. I say, give me 5,000 dishwashers, 5,000 ceiling fans. So I get it at much lower price points than everybody else. And I'm able to stockpile. For example, during COVID, what happened during COVID? We have experienced one of the most difficult supply chain issues in recent history. Most of our competitors were not able to turn over apartments. We're not able to prepare the apartment because they don't have supplies. We had 6 months of supplies of every single item you need in our multifamily real estate. In fact, we started helping our competitors. We started helping our friends, and we started supplying them as well. Because at the end of the day, whether it's their tenant or my tenant, these are human beings and they need to be taken care of. So we have the supply, they don't. Their tenant is suffering, so we open the doors. Here, use whatever you need. We'll take care of it after this issue is resolved. So our biggest difference than our competitors is our operations. We operate our properties ourselves. We are hands-on managers. Now, don't think that it's just me running the show. No, I have a huge team under me. I have about 400 employees full-time, from landscaping to roofing to leasing to management, anything that you can imagine, we have a team for in the company.
That's great. I would also add that you actually said it at the beginning, that you guys focus more on the community itself, on those 40,000 people that you attend to, rather than just, the profit, that the makeup here and there to improve, $50 or $100 per unit. That will come later, but I would say that since you're focusing on the right thing, which is the people, that's really what gets you that difference and how you were able to grow as well. Wouldn't you say?
Absolutely. In fact, we have a company culture to where we do not check the management side. I do not ask my supervisors to check the financials on a daily basis. I ask them to check it on a monthly basis. Wait until the end of the month. I don't want you to be focused on how much rent did I collect today? How much rent did I collect today? Take care of my tenants. If you take care of my tenants, they're going to pay their rent on time. And at the end of the month, you can see if you succeeded or not. That channels our focus to service. Every single meeting we have, it's about how can I improve the service of my tenants? Because if I take care of them, they're going to take care of me. I have properties that are fully occupied, and they have stayed fully occupied for years, meaning nobody is moving out. They stay. Everybody stays. And if one person is to move out, let's say they got a job opportunity, immediately from word of mouth, one tenant will refer another tenant to the property. Hey, come live here. It's typically going to be their relatives or friends, and they create their own community. I have properties that it is one single community. Everybody knows everybody, and they are happy that way because they believe that we're taking care of them. Because if you live somewhere and you're very satisfied, and let's say your cousin lives somewhere and he's very unsatisfied, you're going to say, hey, come live over at my apartment complex. We can be neighbors, and the management is great here. You have just done marketing for me. You have just leased that apartment on my behalf. This is called word of mouth. This is the most important form of marketing, in my opinion, because if I go to your cousin and I say, hey, I'm going to lease an apartment, I'm just another guy. But you, being his relative, his lifelong associate, his friend, he's going to trust you. And you are going to give a sincere opinion, because you're not making the rent money. Well, what is it to you to bring your cousin there? You're genuinely caring for him and you're bringing him. And that's why your cousin's going to come, because he feels safe. So word of mouth is what we focus on. And to get word of mouth, you have to take care of your tenants.
That is just great.
Thank you.
Anyway,
Thank you.
let me change gears here. I know that you guys are preparing for a massive move upwards in the amount of in the amount of units that you guys have. Tell us more about that, and like, how do you plan to do that? Like, what do you need to get there?
Absolutely. This is a very intriguing subject because it's a unique subject. Now, the situation has a lot to do with the economy. It has a lot to do with the market, not just us, but the surrounding factors of real estate. Now, we have witnessed downturns. We, as a company, like downturns. We prefer downturns. We don't want anybody to suffer, but when there is a downturn, when there is chaos in the market, all that means to us is there are opportunities in the market. When everything is beautiful and everybody's paying top dollar for multifamily apartments, how many good opportunities are you going to find? Again, an opportunity in my book is a discount. How am I going to find a discounted property if the market's beautiful and everyone's competing and the economy is booming? So we wait for downturns. When there's a downturn, the number one factor that changes is the ability to get a loan, because the banks become more cautious. Because remember, at the beginning of the conversation, I said the bank puts down 75% of the money. Now, when the market's beautiful, the bank is more brave. They're more comfortable. The market's great. All the properties are appreciating. Let's lend out more money. But when the market turns and we're facing difficulties, distress in the economy, bank becomes cautious. They say, okay, we're not going to lend out as much money. We're only going to lend to our most trusted borrowers. That closes the doors to most of the competition. There are only a very few players left in the market that can buy. Even if other people want to buy, they're not able to, unless you're going to pay 100% cash. And let's face it, these properties are, many millions of dollars. So not many people can just go and pay $100 million cash. 99% of the players use loans. And if they can't get a loan, it doesn't matter if you want to buy it. You can't get a loan. So right now we're experiencing an economical downturn. And the reason for that started during COVID. What happened in COVID is the government started giving out stipends to the public. They started giving out money to the public to help people get by those difficult times. But when you print trillions and trillions and trillions of dollars, at the end of the day, the dollar is a commodity. You are increasing the supply of the dollar. There's more dollars. So what happens is the value of the dollar drops. That is called inflation. The value of the dollar is dropping. When inflation takes place, the item, the same car that was $20,000 this year becomes $30,000. The same house that was 200,000 becomes 300,000. So inflation takes place. There are very few tools that you can use in order to reduce inflation, because nobody wants inflation. One of the tools is to increase the interest rates. When you increase the interest rate, you are saying borrowing this dollar is more expensive for you. You were paying 2%, now you're going to pay 5%. You were paying 3%, now you're going to pay 6%. It becomes more expensive. You are intentionally slowing down the economy by increasing the interest rates. And that's exactly what happened. COVID came, we printed trillions of dollars, we gave it to everybody, which I'm fine. I like helping everybody. The consequences of that translates to inflation. Now, the federal government is trying to battle inflation. The way they're going to battle that is increasing the interest rates. Right now, interest rates are in 5.5%. 2-3 years ago, we were getting 2%, 3% loans. Now you're getting 7%, 8%, 9% loans. So the market changed. Now, when that happens, and on top of that, you have scared lenders, banks are not giving as much money. And if they do give money, they're charging much more interest. There's no competition left in the market. Not only that, here's the big problem. It's not only those who want to buy and are unable to buy. It is also those who have loans and those loans are expiring and they're unable to refinance it. Because when you buy an apartment complex, that loan has an expiration date. It can be 1 year, it can be a 5-year, it can be a 30-year, whatever. But if your loan is expiring during this period where the banks are cautious and they're not lending, then what do? Your loan expired, you have to give the money back to the bank. But you can't refinance. You can't find anybody to refinance you. So they give the keys. They say, look, I can't pay your money back. Here's the keys to the property. Now that is the exact same situation back in the early 90s when Dr. Kalkan entered real estate. All the banks had to take over these properties. And now they're just giving these properties away for the cost of the loan. All the equity is wiped out because the owners forfeited the properties. And that's what we're seeing. We're seeing many owners who are unable to refinance, getting repossessed, turning in their keys. So now these banks that are holding thousands of apartments, they need to give these apartments back to the investors. The bank is not in the business of real estate. They don't want to hold these apartment complexes. They want to deal with money. They want to deal with loans. They don't want to be a real estate investor. So they're looking at, okay, who do we trust in the market that can take this property off of my books and manage it? Well, there's only a few players left. And when you're talking about deep value add opportunities, we're one of a handful of people in the entire city of Houston that do this. So now we have that stack that I mentioned any given day of the week that is available for purchase. That stack has more than quadrupled. Now there's thousands of units that you can take over at any given time. And that's what we plan to do. So we have this portfolio of 10,000 units, and we expect that within the next 1 to 2 years, there's going to be many great opportunities in the market where beautiful properties that we're just simply unable to refinance are now being presented to us, and we will be assuming their loans and we will be growing. Typically, every year, we grow about 25 to 30%, which is a great growth rate. You know, every 3 to 4 years, you're doubling. That's a great growth rate because you started at 4 units, you get to 10,000 units in 30 years. Do the math. But in this next 1 to 2 years, we hope to perhaps double. Instead of growing 30%, we want to grow 100%. And the reason why we think we can do this is because of this environment, because of the distress in this environment. We don't see it as a crisis. We don't see it as a problem. We see it as an opportunity. And in fact, it's, in my opinion, one of the greatest opportunities in recent history. Why? Because in the past, there were other crises as well. Why is this more significant? The reason why this is the most significant compared to COVID, 2008, 1989, is because of what happened after the 2008 crisis. What happened after the 2008 crisis, the banking regulations became very difficult. It became much more stringent to get a loan. It became very difficult so that people stopped going to the bank to get a loan. They went to private companies to get a loan. Now, these private companies are not backed by the government. So most of these are syndicators. So what we see now that was not present before is the volume of syndicators and private money in the marketplace. This private money is now being bankrupted and it has no guarantee behind it. So all of these syndicators are going belly up. Do you understand? So there's nobody to save the day the way that they were able to save it back in 2008 because the banks were insured, the banks were securitized, the loans were securitized. Right now, it's all private money that's burning. So that gives us a much greater opportunity than we had in previous crises.
And how do you plan to get to your goal of like doubling the amount of units by using those investors and like, or by using, what are you going to use? Are you going to use banks, or are you going to get the money from other investors? Like, what do you plan to do?
The short
If you
answer,
can share that,
well, of course, I'm happy to share anything. The short answer to that would be every avenue possible, because right now we are racing against time. This is a short window. As soon as the interest rates start to drop, I'm not saying until they drop back to where they were. No, I'm saying the moment they start to drop, the market will start to recover. Because what the banks are worried about and what many of the lenders are worried about is not when are the rates going to drop back to how they were. What they're worried about is this the highest the rates will be? Or is it going to get worse? Is the worst behind us or is it ahead of us? The moment it starts to drop, everyone's going to say, okay, the worst is behind us. Let's start doing business. And all the doors are going to open. And this window of opportunity is going to shut. So we're racing against time. Now, there are certain avenues. Avenue number one, you assume the loan from the bank with very little to no equity, which is how we started doing real estate in the first place. That is one avenue we're pursuing. Another avenue is cash out refi or selling some properties and getting the equity in those properties. Right now, we're in the process of refinancing and putting a couple of properties out into market. The third is to raise equity, to raise funds and partner to be able to go purchase some properties. Until now, we had very little, if any, partners these past 30 years because we didn't need it. But right now, if we really want to take advantage of this opportunity, the traditional stabilized refinance is too slow of a process. I need 1 year. Okay, that most of the show is over by then. So right now, due to the circumstances, we're going to be raising capital as well.
Great. Let me ask you something. In terms of attracting investors, I read on your webpage that you were also looking to go international, right? So would that be part of like that answer? Like you're getting international investors. Are you planning to invest internationally, or are you planning for those international investors to come invest with you?
Look, the way I see it, America still is the best place to do business.
Mhm.
In America, for multifamily real estate, the best state to do business is Texas.
Mhm.
There's a couple others, but Texas is one of the best. In Texas, you have four cities. You have major cities: Dallas, Austin, San Antonio, Houston. Houston has the most apartment units amongst any of the cities. So you're in the right country, you're in the right state, you're in the right city. I do not plan to invest overseas. I plan to accept investments from overseas and invest here in Houston. And this evolved on its own. We have been approached. We've been approached by many nationalities. You know, it could be the United Arab Emirates, it could be China, it can be Europe, it could be Canada, it could be Mexico. Investors from all over the world are wanting to invest in America. But as is with every investment, they're looking for safe investments. They don't want to lose their money. So when you're wanting to invest in multifamily, but you're not even living in America, it's very important who you invest with. So since we own and operate these assets ourselves, and we've been doing this for 30 years, and we've stabilized over 100 apartment complexes in these 30 years, we are able to attract this attention from overseas. And right now we're in the process of raising funds internationally as well.
Perfect. Perfect. Let me ask you something else. So how, I guess you kind of touched on that little point there before. How do you find the properties that you want to attack and actually get under your portfolio?
Yes, that's a great question. We have a few criterias. Criteria number one is the location. I want to purchase a property nearby a major employer because I'm not thinking about the property. I'm thinking about the tenants. Where are my tenants going to come from? Where is the supply of people? Where are the residents? For example, I have about 6,000 units around George Bush Airport. Why? Because the airport employs thousands of people. If I own the apartment complexes around the airport, those thousands of people that don't want to commute 1 hour to work, they are going to be my tenants. Or I have another portfolio of properties near a Pinto Business Park, which major Amazon distribution center is located there. Major Coca-Cola distribution center is located there. Major Home Depot distribution center is located there. Thousands and thousands of workers there. So that's the first criteria. Find a place nearby a major employer. The second criteria is be nearby major roadways, because roads are the arteries, the veins, the blood veins of a city. You want to be nearby them. All of my properties are strategically located around major highways and major employers. And lastly, is the asset itself. It needs to have a value add opportunity. There needs to be something that I can do to increase its value. I don't want a perfect property. I want to perhaps go live in a perfect property, but it's not good for business. Business means fixing something. You have to fix something to create value. I want something that I can fix. So I'm looking for deep value opportunities. The property might have managerial problems. The manager, the staff is not qualified. They're not professional. They don't know what they're doing. This is one option. It could have high crime. It could be a structural problem. It could have an occupancy problem, meaning that the vacancy is too high. It can have a tenant problem. It's fully occupied, but nobody's paying rent. The tenants are not good. You didn't go do a good screening. You didn't research the tenants well. It has to have a problem. So major employer, major highway, and a deep value add opportunity. These are the three criterias. If we find a property with those three criterias, we jump in.
All right, perfect. So but let me. So we're getting in actually to the last two questions. I'm going to ask you. So what does success look like to you?
Success to me is a vision that I believe a child should be able to play outside. A mother in the middle of the night should be able to get out of her apartment, go across the street, grab a bottle of water, and not be worried about her safety. This is success to me. If children are scared to play outside, if women are afraid to walk outside, if everybody is stressed, everybody has anxiety, this is society collapsing. Success to me is a vibrant, clean, quiet, safe, friendly neighborhood. This is the definition of success to me.
Perfect. And one last question would be, so I don't know if you have any sources of, like, any people that inspire you, or any sources of education, like books or anything like that, that that you can recommend, or that you feel confident in recommending or talking about.
My greatest role model is my father, because he's a textbook definition of living the American dream. Starting from nothing, coming in as an immigrant with $570 to live a whole month. Half of that goes to rent. You have $10 a day to live off of. And fast forward 30 years, having this empire, he would be my role model. Aside from that, I like to follow major players in the market. I like to follow major companies in the market and see what they're doing. But on a day-to-day basis, I'd have to say the number one role model would be my father, Dr. Kalkan, who is the first generation of this company.
Perfect. Great. Anyway, so I wanted to thank you, Ahmed, for being with us today. And any final thoughts that you want to leave with?
I'd say right now it's important to emphasize the significance of the time that we're living in. For those who are a part of real estate, know that these are very special times. And those who do not know, I can confidently say this is the best time to invest in real estate. I'm looking forward to taking advantage of the upcoming year or two. And our goal is to grow. Our goal is to make good investments. And anybody is welcome to join along and enjoy the ride. And I hope to, continue our communication with you, and I hope to work together with you. But yeah, thank you. Thank you so much for your time. And I greatly enjoyed it. I greatly appreciate it.
Thank you so much, Ahmed. We'll
Thank you.
see you later, guys.